For those of you that missed my introduction last week, my name is Richard Kapsch. I'm the Managing Director of Pride Holdings, LLC. We're based in Schaumburg, and we're part of the Pride Group in Dubai. And I'm speaking to you today from Schaumburg. I've got 45 years experience in the futures and stock markets, including 11 years on the Chicago Mercantile Exchange, and 6 years as a member of the Board of Governors of the Exchange. While I was a member of the Board of Governors, I was chairman of the Foreign Currency Committee for the CME. So my experience encompasses just about every job in the industry, so I feel that I'm somewhat qualified to talk to you today. I've got a Bachelor of Arts degree from Yale University and an MBA from New York University. And today we're going to talk about price forecasting. But before we start, I'd like to just make a couple administrative comments. Last week, I guess there was some interest in people being able to ask questions. What we're going to do today is I'm going to stop at the end of every slide and open it up for questions if anybody wants to ask. So just keep that in mind. The other thing I wanted to mention is there was some interest in being able to use this presentation. Last week's presentation is available on YouTube, and if you want the link to it, you can contact the Dubai office, and they'll give you the links to last week's presentation. This week's presentation is also going to be recorded and will be available on YouTube within a day or so. So you can keep that in mind. Now, today we're going to talk about price forecasting, and specifically what we're going to talk about is forecasting foreign exchange rates. About forecasting and trading, the first question we want to ask is, why do we want to forecast? Now, if you're a businessman, what you want to do is take into account all information possible to make your business profitable. And one of the things you want to do is forecast market conditions in the future. This enables you to plan accordingly in terms of your inventories and sales and things like that. Now, what we're talking about this morning or this afternoon is specifically forecasting foreign exchange rates. And there are two types of people that can benefit from forecasting foreign exchange rates. Okay, there are two types of people that are interested in forecasting foreign exchange rates. First are the hedgers. Now, if you're a hedger, one of the things that you're concerned about, particularly if you're an importer or an exporter, is what the foreign exchange rate is going to be when you either make or take delivery. So what you want to do is try and forecast those price rates as accurately as possible to improve your management of the uncertainty accompanying those rates. And you might forecast some price movements that are going to be in your favor. If so, then you may not even want to hedge. However, if they're forecast to be going against you over the period of your hedge, then you want to take some kind of action in the marketplace. The other type of individual that's interested in forecasting foreign exchange rates are traders, which I assume most of you are. And obviously forecasting is important because the more accurate your forecast and the more you have confidence in it, the better your trading results are going to be. For example, if you want to determine the direction of the movement of the markets in advance or as best as you can, and then trade accordingly. Okay, any questions so far? Okay, there are three types of forecasting methods that people use in forecasting foreign exchange rates. First, and what I think is the most important type of forecasting method is fundamental analysis. This type of forecasting method is based on the analysis of the supply and demand factors that affect a particular price. And these are what people in the trade call exogenous factors, factors that are outside the market themselves. The second type of forecasting method is technical analysis. And technical analysis strictly looks at price movements inside the market themselves and doesn't care about what's going on outside the market. And this type of analysis uses endogenous factors. So we've got exogenous factors, exo from the Greek meaning outside of the markets, and endogenous with the prefix endo meaning inside the markets for technical analysis. Technical people that use technical analysis for trading strictly, don't strictly use what's going on in the market themselves. They believe everything's in the price movement. Now, the third type of forecasting is what is known as market-based forecasting. These are people that don't attempt to look at the markets themselves. They strictly look at the forward rate for a particular foreign currency and use that as a proxy for their forecast. Now, my own personal preference is to use both fundamental analysis and technical analysis. Fundamental analysis to give you an idea of where the markets are ultimately going to move. Technical analysis, we'll talk about later, gives you an idea as to where the market's been and what's going to happen in the extremely short term. I don't particularly like market-based forecasting using a forward rate because the forward rate is 100% based on interest rate differentials and may be effective in terms of the very long term. But in the very long term, we're all going to be dead, according to John Maynard Keynes. And most of us are more interested in something shorter term than that. So there are so many other factors that affect the foreign exchange rate in the short term that using a market-based forecasting isn't really, I don't believe, an effective way to forecast. Okay, any questions? Okay. Now, in my opinion, forecasting foreign exchange movements and trying to forecast foreign exchange markets, it's my belief that currencies are the easiest markets to forecast. And the reason being is because currencies generally move on what we term macroeconomic factors, not microeconomic factors. Macroeconomic factors look at what I think are the big pictures, such as relative inflation rates, longer-term interest rates policy. And these are factors that only change in the long term. They don't change from day to day. And these are the factors that affect trends. Now, when you're trading a market, it's my belief that the best way to trade a market is to find a trend and to ride that particular trend. We'll talk a little bit more about trading a little bit later in this presentation. But one thing to always keep in mind when you're trading is the statement that the trend is your friend, don't buck the trend. Don't always try and pick tops or bottoms. Try and find a trend and go with it as long as you can. And it's, as I said, it's my opinion because of the fact that currencies move on macroeconomic factors, that currencies are the best trending markets. Any questions so far? Okay, before we talk about specifically forecasting foreign exchange rates, let's take another look at who are the participants in the foreign exchange market. We talked about this a little bit last week. Generally, when we talk about the foreign exchange market, we're talking about the interbank market, and the interbank market is where they trade $6 trillion worth of currencies every single day. So it's a huge market. And most of this trading is done bank to bank, banks trading for their own account or trading with other banks. And their focus of the banks that trade bank to bank is extremely short term. They're interested in what happens in the next few seconds or few minutes. Okay. So banks are the biggest sector participating in the foreign exchange market. Second largest sector that participates in the foreign exchange market are hedge funds and CTAs. And these are traders whose focus is longer term than the banks, usually overnight, maybe sometimes as long as 1 or 2 months. So they're interested in the longer term factors. And then the third segment of the market are corporate users, which we again talked about last week. Corporate users are hedgers and other businesses that use the foreign exchange markets to hedge, and these are generally the smallest segment of the market. So we've got within the foreign exchange market, the interbank market, we've got 3 major participants: banks, hedge funds and CTAs, and finally corporate users. What we're most interested in is what are the banks doing and what are the hedge funds and CTAs going to do when we're trying to forecast. And as I said, okay, any questions so far?
Mr. Richard, can you listen to us? Is the audio clear?
Yeah, I'm sorry. I can't. Go ahead. Can you repeat that, please?
I'm saying the audio is clear to you.
I'm sorry, what?
Audio. Can you listen to us? Is the voice clear?
Is your voice clear or is my voice clear?
No, our voice from Kuwait.
No, it's fairly clear. It's hard for me to understand it. It sounds like you're sitting in a conference room and listening, so it's a little bit hard for me to understand you when you're shouting.
Your voice is very clear. Your voice is very clear to us.
Did you have a question other than that?
No, sir.
Okay. moving on. Okay, we're going to look at fundamental analysis now. And when we start looking at fundamental analysis, the first thing we wanted to understand is what is a foreign exchange rate? I mean, and strictly speaking, a foreign exchange rate is simply the price of a specific commodity. When you look at fundamental analysis and analyze supply and demand, you can do this for any particular commodity, whether it's currencies, gold, corn, wheat, oil, anything like that. And you look at the supply and demand factors affecting that particular commodity. In the case of foreign exchange rates, the currency is the commodity that we're trying to analyze here. So one currency priced in terms of another currency is just like any other commodity price. And then, as I said, the price for any particular commodity is determined by the interaction of supply and demand. So what we're really interested in is analyzing those factors that affect the supply and analyzing those factors that affect the demand. Now, in fundamental analysis, in terms of forecasting currencies, is a little more complicated than forecasting the price of any particular single commodity. In fundamental analysis, like any other commodity, we want to analyze the supply of or demand for a particular currency. But since there are two currencies involved, we have to analyze the supply factors and demand factors for both currencies and then figure out how they interact with each other. And as I said earlier, what we're looking at is something called exogenous factors, factors outside the marketplace.
Good.
Did you have a question, somebody? Okay. So in fundamental analysis, let's take another look at the trading components that make up the foreign exchange market. We've got, on the one hand, we've got the basic, what I call the basic funds, and these are the funds that are traded by hedge funds and CTAs and have a longer term horizon, longer term trading horizon. And they're interested in factors such as trade requirements, capital investments, and other factors that would affect the foreign exchange rate in the long term. So we want to find out what they're doing, and it's these funds that establish the underlying trend for the market. So we want to concentrate one factor on those. The second trading component that we're interested in is marginal funds. And these are by far the greatest percentage of funds that are trading. And these are the banks trading with other banks and speculators who have a very short-term horizon. So when you're looking at a long-term trend, you can draw a trend line that it goes over a long period of time, but you have these fluctuations above and below the trend line on a short-term basis, and these are what is caused by the movement of these marginal funds, banks trading with other banks and speculators trading for the short term. Okay, the basic funds, as we said, move much less frequently than the marginal funds because they've got a long-term trading horizon. They respond to long-term factors, as I said, and probably the most important factor affecting the long-term funds are relative inflation rates. And what inflation determines is something called positive real interest rates or negative real interest rates. And those are determined by taking the nominal interest rates, what banks are charging for their, let's say, the prime rate or lending rates, and subtract that from, or subtract the rate of inflation from that nominal rate, and it gives you a positive real interest rate. So example, if a bank is charging 4%, or if a bank is paying you 4% nominal rates, but the rate of inflation in a particular country is 3%, 4 minus 3% gives you a positive real interest rate of only 1%. So you have to, so these basic funds that move less frequently keep real interest rates in mind. And ultimately they move toward purchase power parity equilibrium. What this simply means is in the long term, every foreign exchange rate is going to be adjusted to every other foreign exchange rate in terms of these positive real interest rates. So if some country has higher inflation than another country, its foreign exchange rate is probably going to go down relative to that other country. However, the other factor that I mentioned is that purchase power parity equilibrium is something that only occurs in the very long term. So we want to keep that in mind, but we don't want to trade on these factors. Basic funds look at long-term government policies, and with the one caveat being that they prefer conservative economic policies because conservative equates to stability. And as examples, if people go back to the late 1970s, early 1980s, we had a case in Britain and in the United States where inflation was extremely high. We had double-digit inflation in both Britain and the United States. And what happened when Margaret Thatcher took over in Britain in 1979, she established a conservative economic policy whose primary goal was to defeat inflation. And Ronald Reagan came in a year later, and he instituted the same type of policy in the United States. And as a result, people started to move their funds from other foreign currencies into the dollar and into the pound. So what these longer-term basic funds are looking for are conservative economic policies that bring stability to a country. So far, let's say if we take a look at Donald Trump's experience so far, you know, we're not sure what his long-term government policy is going to be, and this, I personally think that this could be a little bit negative for the dollar as we go forward, unless he starts to institute some kind of a more conservative, stable economic policy. Now, these long-term factors, these long-term government policies and relative inflation rates, as I said, are what establish the underlying trend in a particular currency. So we want to keep these in mind when you're trading, you want to go with the underlying trend rather than trade against it. Particularly if you're somewhat longer term in nature in trading. Do you have any questions so far?
Hi, Richard.
Yeah.
Just one question I want to find out. I think you spoke about banks. I think it's in the previous slide where you spoke about banks and all that. Now tell me, when it comes to like your Reserve Bank interest rate and monetary policy and all that, you do like recently. I've seen that I think it's the Federal Reserve Bank did raise interest in America, and usually what should happen, or basically what should happen according to my understanding is when you raise your interest rate, then it must affect the currency positively. But relatively all along, you see the dollar is in a way weakening. What would cause that?
Okay. In general, you're absolutely right, and we'll talk about this a little bit more in a couple more slides. But when the country raises its interest rates, it should have a positive effect on the currency. However, the problem with this analysis, that particular analysis, is that there are other factors that are competing for importance with the relative interest rates. The other thing that's important is that for months, people have been anticipating that the Federal Reserve is going to raise interest rates, and as a result, the market moves accordingly. So we have something that's called buy on the rumors, sell on the news. So when, the market had been anticipating a rise in interest rates by the Fed for some period of time, that when it actually happened, it actually had a negative effect on the market. So like I said, you have to take into account all these competitive factors in making your analysis, and we'll talk a little bit more about that as we go on. Okay? Any other questions so far?
No, sir.
Okay. Okay, we looked at the basic funds. Now let's look at what I had called marginal funds, which are the funds involved by bank-to-bank trading. Now, one of the most important factors in currency trading over the past 10 to 20 years has been technological developments in the market, particularly in the area of communications. When I started in the markets, or 20 or 30 years ago, if you wanted to trade foreign currencies, everything was done over the phone, and it took a lot of time. Now we've got high-frequency trading, all sorts of other trading going on that has shortened the time factor in terms of these trades. So we have to keep in mind that we're talking about computers and the technological capabilities of traders improving to the point where the movement of marginal funds is much faster than it was before. The other thing that I've seen over the last 10 to 20 years has been a decline in the importance of gold as a trading element, particularly when it comes to foreign exchange. 10 to 20 years ago, people used to buy gold for two primary reasons. One is a hedge against inflation, and the other as a safe haven in case of upsets in the particular market, like war in Kuwait, and like when Iraq invaded Kuwait in 1990, etc. Now, because it's so easy to move your funds from one currency to another currency, gold has lost its importance in these particular areas. What people do is, instead of putting their money in gold as a hedge against inflation, they'll move it into some currency whose economic policy is more effective than others. Looking at marginal funds, at any moment in time, these marginal funds are in a short-term equilibrium, and by a moment in time, we're talking about the briefest moments. We're talking about fractions of a second. And what I mean by short-term equilibrium is that investors and traders have diversified their investments or allocated funds among various currencies according to the interest rate differentials that exist in the market at that specific moment in time. So what happens if we get a minor change in interest rates? If we get a minor change in interest rates, the higher rates attract funds, as we talked a few minutes ago. So if, let's say, if normally what would happen if some central bank or some other factor in the market comes out and affects the interest rate in a positive manner, what we're going to get is a shift from the currency with the lower interest rates to the currency with the higher interest rates. But as I said, there are other factors that are extremely important that we have to look at the same time. And one thing that also we've got to take into account are expectations of changes. So, as I said before, the Fed last week raised interest rates 0.25%, but everybody in the world was looking for that for the last month or two or more. And as a result, we had an exhibition of the saying, buy on the rumor, sell on the fact, where people have been trading, you know, in anticipation of a Fed interest rate change for several months, and by the time it actually occurred, it was in the market, so people just generally sold on the fact. So buy on the rumor, sell on the fact. Okay, so let's talk about fundamental analysis a little more specifically. And as I said before, when we're looking at fundamental analysis, we want to look at the supply factors that affect the supply of a particular commodity, and demand factors that affect the demand for that particular commodity. In the case of currency, what are we talking about? The supply of what? In this case, we're talking about the supply of currency in a particular country or in the marketplace. And when we talk about currency, we're really talking about money. Now, we want to answer the first question we want to ask is, who creates money in a particular economic environment? And the answer is either banks themselves through loans or central banks by buying and selling in the market. So when the Fed says they're raising interest rates, what they do is when the Fed tries to change the money supply, what they do is they'll buy or sell treasury bills in the marketplace or other types of banknotes. So it's the central bank, even though banks and central banks create the market, create the money supply, and it's the central banks that control the money supply. And so we want to ask our question, how do central banks control the money supply? Through credit policy. And higher interest rates constrict supply, we keep control over the money supply. Lower interest rates expand the supply. So what we want to do when we're analyzing the supply of money, we want to try to anticipate central bank action or expectations. So in this case, what happened, everybody in the world is anticipating a 0.25% rise last week by the Fed. So, you know, you've got to go back several months to start trading in anticipation of these movements. Now they're talking about the central bank possibly, or the Fed possibly raising interest rates another 2 or 3 times this year between now and the end of the year. So we're going to people have probably already started anticipating the central bank action or the Fed's possible raise it for the next interest rate hike. But what we try to do is we try to anticipate central bank actions when we're forecasting the supply and what's going to happen to interest rates. So, yeah, go ahead.
Just before you move further, then when do you determine that now it's time to buy on the rumor? Like now the rumor is, do you just jump into it now, or is it a couple of months before the actual interest rate? When do you decide that?
Well, we'll talk about this in a little more detail, but generally, what fundamental analysis tells you is where the foreign exchange rate should be ultimately. So we've got the Fed. People have already anticipated the Fed's going to raise interest rates a couple of times. So it's hard to trade on fundamental analysis alone, and that's where technical analysis comes in. And we'll talk about this a little more today and then at a future webinar. But my own preferences in terms of trading is to look at the fundamental analysis which tells me where a currency should be, but technical analysis tells me how's it going to get there. Do we have a trend? Where are the support and resistance? And we'll talk about this a little bit later. So you've really got to look at fundamental analysis and technical analysis when you're trading, I think. That's my own personal opinion. Okay? So getting back to the supply factors or the control of the supply of money in a particular country, what we want to make a basic assumption that central banks are most concerned with inflation and that they're going to control inflation before encouraging economic expansion. There's, for example, in the Fed's case today, inflation in the United States doesn't seem to be much of a problem. We're probably around 1 or 1.5% on an annual basis, which is nothing comparing it historically. But the Fed seems to be more concerned about controlling this inflation than worrying about economic expansion, whereas most businesses and consumers in the United States would prefer to see the Fed do things to expand the economy. But the U.S. economy is only growing at a rate of 2 to 2.5% a year, which is well below what it needs to have a healthy expansion. But the Fed seems ready to jump on the economy at the first sign of any kind of increase in inflation rather than worrying about economic expansion. Now, this goes back to some experiences that central banks have had in the past with inflation. Let's take the European Central Bank, which is, since 1999, is effectively the successor to the Bundesbank. Prior to 1999, people used to look to the Bundesbank and Germany as the leader in terms of what economic policy should be. And the Bundesbank goes back to 1923. We talked about, remember, learning lessons from World War I when when the Bretton Woods system came to pass. And in 1923, Germany went through a period of hyperinflation where we talked about inflation running hundreds of thousands of %. And this is put a scar on the German psyche that they can't seem to ever forget. And so the Bundesbank always, their main interest always was to control inflation rather than worrying about economy. And then when the European Central Bank came in, it has simply adopted the same policy. So the European Central Bank tends to fight inflation rather than encourage economic expansion. With the Federal Reserve, their experience with inflation, it wasn't as bad as the 1920s in Germany, but there was some concern in the 60s and 70s. If you remember, we said that one of the reasons the Bretton Woods system broke apart was that in the 1960s, President Johnson tried to fight the Vietnam War and pay for the Great Society, in other words, have guns and butters, and as a result, he started an inflation that started to take off. In the 1970s, we actually had double-digit inflation. By 1979, it was up to 12%, and this a little bit of inflation might be good for an economy, but inflation of that magnitude obviously is not. In 1979, President Carter appointed Paul Volcker as chairman of the Federal Reserve, and first thing he did was jack interest rates up sky high to choke off inflation. In 1980, we saw the prime rate in the United States got up to 21%, which is the highest I've ever seen it. But, you know, and following Volcker, we had Alan Greenspan came in for the next 10 to 15 years, and their policy was the same as the European Central Bank and the Bundesbank: fight inflation first, and then worry about the economy a little bit later. Everybody with me so far?
Yes, we are, Richard.
Okay. All right, so we want to do, in terms of analyzing the supply of a particular currency, is one, we're basing it on this assumption that the first thing the central bank of any country is going to do, particularly the developed nations, is fight inflation. So what we want to look for when we're trying to trade or forecast foreign exchange rates is look for any signals that inflation is increasing in a particular country, and that might bring higher interest rates. And of course, the first thing we look for is signs of economic expansion. And, you know, in the Fed's case, the Fed seems to be more confident in the economy than a lot of the people living in the United States are, but they seem to think that we're ready to take off, and so that was one of the reasons why they went and raised interest rates. Other things you might look for are increases in price indices: the Producer Price Index, the PPI, Consumer Price Index, the CPI, and average hourly earnings. So all these things are measures of what's happening in inflation. If you start to see these things tick up, then you figure the Fed might raise interest rates sooner rather than later. As I said, it's pretty much, you can believe that they're going to raise interest rates probably 2 more times between now and the end of the year. The question is the timing of these increases. The other thing that could bring higher interest rates is increases in government spending. One of the things that Donald Trump promised before he got elected was to spend a lot of money on infrastructure, the highways, railroads, and bridges, and everything in the United States that's been neglected for the last 10 or 20 years. And this is is one of his goals, to bring jobs to the United States. However, we're going to see tremendous increase in the government debt because of it. They're going to have to spend the money. They're probably going to spend the money before they can raise it in taxes, and they probably won't raise enough money in taxes to pay for the government spending. So one thing to keep your eye on over the next few months is what happens in terms of his plans to spend on infrastructure and how he's going to pay for it. If it looks like he's going to add to the government debt, then simply that's probably going to mean that the Fed is going to raise interest rates higher than before. The other problem, though, is it depends on the magnitude of the increase in government spending. If it's so much that a 0.25% here, a 0.25% there, and interest rates aren't going to be effective in controlling government spending, or the inflation resulting from increases in government spending, then we could see, even though the Fed raised interest rates, a decline in the dollar. And I think that's another factor that's contributing to the fact that the dollar is heading lower over the last couple of months. Okay, but in general, higher interest rates, you can say that higher interest rates lead to a stronger currency. Okay, let's take a look at the demand side. And demand, greater demand also means higher interest rates. So, in looking at supply and demand together, in supply, we might see an expanding economy could lead to higher interest rates, and higher interest rates lead to a stronger currency. In the demand side, the relationship between demand and interest rates is more direct, where as the economy expands, there's going to be an increased demand for loans and credit, and interest rates are going to rise accordingly because of the demand for credit. So we can say that as the economy expands, we will see increased demand. If the economy declines for some reason, we show decreased demand. Increased demand leads to higher interest rates. Decreased demand leads to lower interest rates. Now, what is the relationship between the demand for a currency and its supply? And there's an equilibrium generally where you take a look at the supply curve and demand curve, and where they intersect gives you the appropriate level of a foreign exchange rate. But in general, what we're looking at is higher interest rates generally mean a stronger currency, lower interest rates, weaker currency. Okay, so in analyzing demand factors, we want to look at some important numbers in the economy. We want anything that tells us how the economy is doing today. And probably the most important report that people look at in terms of trading is the monthly employment report, which usually comes out on the first Friday of the month. This month it came out on March 10th, which was a week ago last Friday. And it showed within the monthly employment report, what we're most interested in is the number of non-agricultural jobs created by the economy. And that report said that in February, the economy created 235,000 jobs. Now, this was a little bit more than expected. What we're interested in the absolute number, but what we also want to do is compare what the forecasts for that number are compared with the actual number. So in this case, in February, we created 235,000 jobs. And the fact that that was more than they were forecasting, I think they were forecasting probably close to 200 to 175,000 jobs. The fact that there were more jobs created says that the economy is doing stronger, and as a result, the economy doing stronger, interest rates should go up because of the demand for funds. So that should have had a bullish effect on the currency. The reason I list the monthly employment report first on this thing is because It's the earliest indication of how the economy is doing. It's the most current information you can get on the particular economy. So it comes, as I said, it comes out the first Friday of each month, which is usually 2 or 3 days after the month closes, and you can't get any more current economic data than that. Probably the second most important thing is the quarterly gross domestic product. Now this comes out every month, but when we talk about quarterly, it's for each quarter of the year. So right now we're operating, the most recent data we have is for the fourth quarter of the year, January, February, March, or the fourth quarter, October, November, December. The first report on the quarterly domestic product for the fourth quarter came out in January, and then it gets revised in the next 2 months. So it was revised in February, revised in March, and as I said, it's running about 1.5%, which seems a little bit on the slow side, but I think given the fact that employment was greater than expected, it's probably doing better than in the first quarter of this year than it did in the fourth quarter of last year. So what'll happen is sometime around the middle of April, we're going to get the GDP figures for the first quarter, January, February, March, and we'll have to look and see what they're anticipating as we get closer to that particular number. So the second most important number to keep your eye on when you're trading is the GDP figure. And remember that only in the first month of each quarter is the earliest report for the previous quarter. The second and third months are simply revisions to the first number. Other reports we look at are that give you a measure of how the economy is doing, are retail sales, which are reported on a monthly basis, and simply tells you how, obviously, retail sales change from month to month. The second is industrial production, which basically tells you how businesses are expanding their spending on a month-to-month basis. The third figure is housing starts, the number of houses that are started being built around the country in a particular month. All these are monthly reports that relate to data for the previous month. Durable goods is a little bit less important because this number changes wildly from month to month and includes things like refrigerators and stoves and other durable goods like that, but it also includes aircraft. So if Boeing has a good month, you're going to see a big jump in durable goods, but it really doesn't give you a good picture as to what's going on in the economy. And finally, we got capacity utilization. That tells you what percentage of a factory is being utilized. As it gets close to 100%, that tells you that companies are going to want to start borrowing money and spending more to expand that capacity, and that'll also have a positive effect on the interest rate. Now, the other thing we look at are non-government surveys, and two of the most important ones are the consumer confidence that's put out each month that tells you how consumers feel about the economy. And this is probably even more important than some of the economic reports, because if consumer confidence, as it starts to increase, then consumers are going to start to spend more. And one thing to remember about economic strength in a particular country is that generally 70% of the economy is based on consumer spending, at least in the United States it is. So consumer confidence becomes very important. If consumer confidence starts to pick up, then it's going to have a very direct impact on the economic expansion in that particular country. A second one that comes out twice a month is the University of Michigan report. They put out one the second Friday of the month, and then the fourth Friday is a revision of the first one. and that's another measure of consumer confidence. So these two numbers are pretty important to pay attention to, because even on the surface, you know, the economic numbers, but it's the consumers that are ultimately going to govern how fast the economy expands. Any questions so far?
All right, Richard. Sorry, I'm asking a lot of questions. Tell me, what I do see, especially regarding inflation and interest rate, and I think you've mentioned that high inflation means the economy is doing well. If I'm right, and what happens is then interest rate is raised in order to slow down the inflation or something like that. And my question is, if the economy is doing well, why do we slow it down?
Well, okay. Generally, what central banks have is a target range for inflation, and it generally runs 2 to 3%, you know, on an annual basis. Now, the U.S. inflation is running below that at 1.5 to 2%. So, my own particular opinion is that they should allow inflation to expand a little bit. That I personally don't see any reason why any fear of inflation taking off all of a sudden, even though interest rates are very low. Historically, obviously, they had to have high interest rates to control inflation, but given the current climate, inflation is extremely low, and I don't see any signs of inflation taking off on the other side. We've got, for example, grocery prices in the last month were down in the United States. Oil prices are coming down, so these are two direct influences on inflation. So as these, so my own opinion is that the Fed can hold off in terms of raising interest rates, and I would probably feel the only problem is the people on the Fed that make the decisions to raise or lower interest rates, mostly what we call inflation hawks. They've got this experience, or look at this experience of the U.S. in the 60s and 70s of high inflation and what it took to control it. And they don't realize that maybe the situation has changed in that period of time. So my own feeling is they should allow inflation to go up to 2-3% or so if they can, and that would be positive for the economy rather than keeping it where it is at roughly 1%. But, you know, as I said, you've got these inflation hawks that want to control, you know, inflation first and worry about the economy second. So I don't know if that answers your question, does it?
It does, thanks.
Okay. Any other questions before we move on? Is that a question? I'm sorry. Yeah. Okay, we've looked at supply and demand. Let's look at some other influences on the markets. One of our government actions that don't directly affect the day-to-day operation or month-to-month operation of the economy, and one of them relates to taxes and budget deficits. Now, Trump has just come out with a new budget that's drastically cutting, that's going to drastically cut spending, particularly on domestic policies, spend more on the military. The problem is, you know, it's his plan for a budget, and the chances of it getting accepted are probably non-existent. But that's going to, one concern that's hanging over the market is if he cuts spending drastically in these areas, and, you know, that's one of the reasons why the stock market was down big yesterday. Another thing that's really in the forefront nowadays are quotas and trade restrictions. Trump is doing a lot of talking about rewriting NAFTA, imposing all sorts of trade restrictions on Mexico and China and some of these other countries. And these two can have an effect on the markets. For example, if my own feeling is if he starts imposing trade restrictions so that global trade slows down, this is probably going to be negative for the dollar over the longer term. And then the last thing you have is also the markets have to pay attention to what I call the jawbone or windbag effect, where politicians come out on a daily and make some comments, or not just make comments or issue tweets like Trump does. So you got to keep one eye on your Twitter account and see what Trump is saying, because that can have a major impact on the currencies. There are also international events that have an effect on currencies. One of them is a flight to safe haven. If something's going on, let's say one example might be as Putin starts to try to expand his influence in Eastern Europe, particularly in the Ukraine, if he does something regarding what you might see as a flight to safe haven, where people move money out of the euro, which is in close proximity to Russia, into the dollar as a safe haven, or maybe the Swiss franc. But generally, the dollar is the safe haven currency, so you've got to keep in mind the effect these events can have. Okay, let's talk briefly about technical analysis. Now, we spend most of the time talking about fundamental analysis, and as I mentioned earlier, fundamental analysis points where the exchange rate should move in the longer term. But the question is, as I said, in the longer term, we're all dead. And what you're really interested in, what's going to happen where the market is tomorrow. So this is where technical analysis comes in. Technical analysis is best for timing entry into and exit from the markets. And as I said, technical analysis, which we'll talk about in several weeks in a separate webinar, but the key elements of technical analysis are what we call endogenous factors, where the market has been and what the price has been over the last few months, rather than anything outside. And it's technical analysis that can determine the trends in the marketplace. And what you want to do when you're trading is you want to go with the trend rather than against the trend. So technical analysis is by far better than fundamental analysis for that. And then finally, technical analysis looking at charts can give you support and resistance levels. Support where you might want to buy the currency, or resistance where you might want to sell it. You look for troughs and peaks, sometimes important price levels are important. Let's say like 1.20 or 1.30 in the British pound to the US dollar might be an important support or resistance point. So to get back to one earlier question is, fundamental analysis is good for the longer term, a little bit longer term, and where interest rates should move. And it tells you what determines what the trend is going to be. But what you have to do is, I think, use technical analysis to look and see where the trend is, what kind of trend is in the market, and where you might find support and resistance. And as I said, we'll talk about that in a couple of weeks when we talk about technical analysis in one of these webinars. Any questions so far? No? Okay. Who's? Okay, finally, what I'd like to do is make a few comments about trading foreign exchange markets. And I find in the foreign exchange markets, there are three major principles that you should adhere to in terms of trading. First is that major profits are made through riding trends rather than trying to pick tops or bottoms. I don't particularly like day trading. You know, I think day trading, you're trying to pick a top and a bottom, and it either goes in your direction or it doesn't. Most of the time, it goes against you. Whereas when you look for entry levels and trends and ride that trend as far as you can, you know, that's more effective than trading. And the way I prefer riding trends is once you've entered into the market and you're riding a trend, use a trailing stop, which we'll talk about, I think, next week again when we talk about stops. And then as the market moves in your direction, simply move the stop up and continue to ride the trend until it turns against you and you get stopped out. But as you move the stop up, you're constantly locking in greater and greater profits as you go, rather than trying to pick an entry point or an exit point. Okay, so that's comment number one. Comment number two, or general principle number two, is cut your losses short and let your profits run. As I said, you can let your profits run by riding a trend with a losing stop. If you enter into a market and it doesn't do what you think it's going to do, get out as quickly as possible and conserve your capital. Don't sit there and say, well, I think, you know, I entered in because, you know, I thought the Fed was going to raise interest rates and the dollar's going to get stronger, but it's not doing what I want now, but longer term it's probably going to, that kind of mentality is going to cause you to lose all your capital. So what you want to do is cut your losses short and let your profits run, and simply save the capital, save capital. There's always another trade to make. And finally, a comment about successful traders in the market. Successful traders find that 70% of their trades are losing trades and only 30% are winning trades. Now, that, if you're familiar with American baseball, that's a 300 batting average, which would get you in the Hall of Fame. But the idea that they lose money on 70% of their trades and make money on only 30%. The reason is the reason they're successful is the winners are much bigger than the losers. So they cut their losses short, let their profits run. And just keep that in mind, that, you know, successful traders don't win 100% of the time. They only win 30% of the time. But those trades are the profits are much bigger than the losses that they incur. Okay, that's generally all I've got to cover today. Is any other questions that people have? Anything I talked about?
Yes, Richard. Just my last question, especially regarding your successful traders theory that you've put in. How does one change that? Look, I'm personally new in trading. Only been like a year trading, and I find myself most of the time that my focus in terms of profit, when I look at usually at my support and resistance in terms of where I enter a trade and where I get out, where my stop loss is. Generally, most of the time I find that my stop loss is higher than what my take profit would be. For instance, you would find that when I enter a trade, say my take profit is when I look at where my resistance line would be if it's in a buy, my take profit would be say $50, but when I put my stop loss in terms of where my support is, you find that my stop loss is about $150. Then how do you work on that in terms of making sure that your take profit is higher than your stop loss?
Well, what you want to do is when you enter into the market, first of all, you've got to conserve your capital and don't commit 100% of your money into one individual trade. And so that's step number one. Maybe commit a maximum of 30% of your funds and keep 70% in reserve for if you're absolutely convinced that you've got the right thing, and that would have led you to put a little bit lower stop. Maybe your stops are a little bit close to where you entered the trade. Second thing is to look for trends and try and ride these trends. And when you get in, you put a stop loss as to where maybe put a stop loss into where it keeps your losses under control. But remember that you can afford, by not committing all your capital on one particular trade, is that you can be more successful in the long term. So just, and don't look for profit objectives. Like you said, at one point you made $50. That may be fine. With a stop loss under that, where you lose $150, but put your stop loss a little bit lower, and if the market doesn't do what you hope it does, then get out. Don't wait for the stop to stop you out. But if it starts to move in your direction, using a trailing stop can be an effective way to make profits. Does that make sense?
Yes, it does. It does make sense. However, I'm still a bit puzzled. Well, in a sense that how do I determine now that stop loss in terms of the fact that now the stop that you're saying I must put the stop? How do I then determine that? Because usually what I would do, if I can just give you an idea of how I trade, is I would put my stop and profit based on my support and resistance line. Say if I put a resistance line or support line, and once we cross the line, then I would open a trade, and then my target would be the next line. or pivot point, the strategy that I'm using. Now, you do find, like I say, most of the time, the profit to the next support or resistance line, whether it's a buy or a sell, it's not as much as my stop loss is. My stop loss is standing at $150, whereas my take profit based on the pivot, the next pivot line, is standing at $50. Now, what do I do? Do I just get out of the market based on the fact that it's moving 50 pips against me? How do I determine this?
Well, first thing is when you look at support and resistance points on the chart, you got to remember that you're not the only person with that chart. Everybody in the world has the same chart. So everybody knows where the support and resistances are. And what some traders with more capital will do will go down and expect that people put stops in right at that support level. So first thing you've got to do is pick a stop level that's below what looks like the support level on a chart. The second thing is trying to identify a trend as soon as possible, rather than if your stop is 100 points below your trade point and the resistance is only 50 points above, then it's just the likelihood if the trend is down to start with, they're gonna go down and look for your stop right at that support level. So I think you probably should be looking at a way to get into trades earlier, and you might have more success than waiting until the trend's only 50 points from the stop level. But you got to remember that traders are going to be looking for those stops. Okay?
All right. Thanks a lot.
Any other questions around? Okay, thank you for your attention. And we've got another one next week on risk management and trading that I hope to see you all again next week. Okay? Thank you.